Understanding risk in finance, a comprehensive overview. Risk plays a critical role in the world of finance. By understanding risk, investors and business managers can make more informed decisions and manage potential losses effectively. This article aims to provide a detailed exploration of risk, its various types, how it is measured, and strategies to manage it. What is risk? In financial terms, risk is defined as the chance that an outcome or investment's actual gains will differ from the expected outcome or return. This includes the possibility of losing some or all of an original investment. Understanding risk involves not only identifying what could potentially go wrong but also quantifying how much risk one is willing to take. Quantifying risk. Historically, risk assessment involves analyzing past behaviors and outcomes. Standard deviation is a key metric used to measure risk. This statistic provides insights into the volatility of asset prices in relation to their historical averages, enabling investors to gauge how much variability they might expect in their investment returns. A higher standard deviation indicates increased volatility and, consequently, a higher risk level. Key takeaways. 1. Risk encompasses various forms, including the potential for both gains and losses. 2. Different risks can be quantified in different ways, allowing for analytical assessments. 3. Diversification and hedging strategies are effective methods to mitigate risk. The basics of risk. Every day, people engage with different types of risk, whether from driving, investing, or capital planning. For investors, personal factors such as personality, lifestyle, and age influence their risk profile, their willingness and capability to accept risk. Generally, higher risks are associated with the expectation of higher returns. Risk and return relationship. A fundamental principle of finance is the risk-return relationship. As the level of risk increases, the potential reward typically rises. For instance, an investment in U.S. Treasury bonds is considered low risk, providing lower returns compared to corporate bonds, which offer higher returns but also come with a greater risk of default. Types of financial risk. Risk can be broadly classified into two categories: systematic risk and unsystematic risk. Systematic risk. Also known as market risk, this refers to risks that impact the entire market or large segments of it. Factors influencing systematic risk include interest rate risk, changes in the level of interest rates. Inflation risk, the risk that inflation will outpace returns. Currency risk, impact of currency exchange fluctuations. Political risk, potential changes due to political upheaval or instability. Systematic risks cannot be easily reduced through diversification. Unsystematic risk. These risks are specific to a particular company or industry and can be mitigated through diversification. Examples include business risk, the operational viability of a business. Credit risk, the threat that a borrower may default. Legal risk, changes in law resulting in financial losses. By investing across various sectors and asset classes, investors can diminish the impact of unsystematic risk. Riskless securities. Though no investment is truly devoid of risk, certain securities are considered riskless due to their low volatility. These include certificates of deposit, CDs, U.S. Treasury bills, government money market accounts. Such securities serve as baselines in analyzing risk and provide safe options for emergency saving or immediate liquidity needs. However, it is essential to remember that deposits exceeding FDIC insurance limits can still be at risk. Managing risk, strategies and considerations. Diversification remains the core strategy for minimizing risk. This involves spreading investments across various asset types to reduce exposure. Key considerations for effective diversification include investing across different asset classes, stocks, bonds, mutual funds. Investing in various industries and sectors. Maintaining an appropriate balance between high and low-risk assets. Risk management techniques. 1. Hedging, using financial contracts to offset potential losses. 2. Asset allocation, adjusting the composition of a portfolio based on risk tolerance and investment goals. 3. Regular assessment, ongoing evaluations of risks and portfolio performance. Psychological factors affecting risk tolerance. Investor psychology significantly impacts risk tolerance and investment behavior. Cognitive biases, such as loss aversion, can lead investors to avoid risk altogether, even when it might be in their best interest. Understanding these internal factors can aid investors in making better financial decisions aligned with their risk profiles. Conclusion. Risk is an integral part of investment and financial decision-making. By understanding the various forms of risk and employing effective strategies to manage them, investors can safeguard their investments while aiming for desired returns. Managing risk through diversification, regular assessment, and awareness of psychological factors not only enhances financial decision-making but also fosters long-term investment success. Ultimately, finding the right balance between risk and return is crucial for achieving financial goals with confidence and minimizing potential drawbacks.